All right, let's move to the economy now. Surging COVID cases and an unpredictable economic rebound is worrying investors. Global markets slumped yesterday with the Dow sliding nearly 260 points. But a part of the economy we are seeing just explode is the housing market as home prices are rising at record rates. If you're selling, it's a great time for you. If you're buying, good luck.
It's crazy. It is just crazy. And it seems like it's crazy everywhere, Mika.
As one industry expert quipped, if you have to sleep on it, you won't sleep in it. Joining us is former Treasury official and Morning Joe economic analyst Steve Ratner.
Hey, Steve, before we get to the crazy housing market, and again, it's crazy, it seems, all over the country. The Wall Street Journal this morning saying that I think they were saying that bond prices are suggesting that the inflationary pressures may not be as bad as some feared, and also suggesting that the markets believe the economy's recovery may not last as long and be as sustainable as once believed. What's your take on that?
Yes, the mood in the market has definitely changed a little bit, and there are really two reasons that you alluded to, Joe, that I'll just flesh out slightly. One is the potential resurgence of COVID cases. We really haven't seen much of a resurgence here in this country, but the Delta variation has now gotten to 50% or more of the cases here, and we know it's highly contagious. And so there are fears that there may have to be some kind of retrenchment from the full opening that we've all been able to enjoy these last several months anyway. So that's hanging over the market. The other thing that's hanging over the market is the question of how much more stimulus is going to get passed in Washington. I think some of the excitement in the market was around the idea that we were going to have $2, $4, $6, $8 trillion of essentially unfunded stimulus programs coming into the economy, which would have created inflation in all likelihood, in my opinion anyway, and would have affected the economic recovery. But now the bond market at least perceives that the politics in Washington are such that whatever it gets passed is going to be smaller rather than larger. It is more likely to be paid for than to be unpaid for. So the market is a bit more relaxed about the money that's going to come sloshing into the economy from Washington over the next few months.
So let's talk about this housing market. The interesting thing about the housing market is whether I'm talking to friends that are in South Florida, that are in the Northeast, that are in upstate New York, that are out west, doesn't matter where they are, rural, urban. It seems like the housing market is crazy everywhere. What's going on?
The housing market is crazy everywhere. That is an absolute fact. And there are a number of reasons for it. And as Mika said, of course, it's great to be a seller, not so great to be a buyer. But we can take a look at some charts that'll give you some sense of what's going on out there. So first of all, prices have escalated enormously, as you said, and the dotted red line is the trend line that we've had for the last several years of house price increases. And then in April, we got the biggest single increase in a month that we've ever had, 15%, up 15%, taking the average house to $315,000. If we had stayed on trend, it would have been more like $290,000. And then on the right, you can see that houses are just being snapped up on the market almost as fast as they're putting them on them. The average house now stays on the market only 39 days compared to 59 days over the last couple of years. So it is a red-hot seller's market. Now the question is why. One big factor in why is interest rates. So you can take a look at what's been happening to interest rates. We all kind of know this, I think, but it's pretty dramatic when you actually see it. Mortgage rates, which have been coming down pretty substantially since the great financial crisis, took a huge tumble right around COVID, from around 4% to around 3%. And that dramatically increases the affordability of houses for people who get mortgages. The math is that if interest rates go from 4% to 3%, your interest bill, because of compounding, is actually 39% less than it would have been over the time of your mortgage. And so people are able to afford more houses, bigger houses, and they're going out and they're finding them. The other thing that we should talk about, and the other factor I want to mention, is the supply of houses. We actually don't have enough houses. Why don't we have enough houses? Because as you see on the left chart, during the great financial crisis, where we had overbuilt, in fairness, before, housing starts plummeted down to around a million houses being started, which is way below what we need to deal with new households being formed and increased population. It then has been gradually working its way back up But if you look at the right, where it shows you what the trend was again, you can see where the trend was going and where we actually ended up. We're about 4 million housing units, whether it be apartments or whether it be single-family houses, about 4 million short of where we would like to be or where we should be, given the growth in the population and the increase in household formation. And so that's the pressure cooker we're in. Not enough houses, very low interest rates. And also, by the way, people's balance sheets are in very good shape. They saved a lot of money during COVID because they couldn't spend it, and now they're out spending it.
Yep.
And house prices are the ultimate reflection of that.
Yeah, Steve, I was going to actually ask you about that. Over the past couple of months, it seemed like a bubble because, if things seem to be too good to be true, they're usually too good to be true. And, how could it be that everybody could sell their house wherever they are and seem to be making, 20, 30, 40% on it? So then I started talking to smart people like you, started talking to bank executives. And whenever I drew the comparison to 2008, is this going to be a bubble like 2008? I'd always get the same answer, no, because 2008 obviously was a credit crisis. Here, so many people are paying cash for this. And so I'm wondering, our savings rate was so low in 2008 when we had the crash. Has our savings rate gone up significantly over the past 13 years?
They've gone up significantly very recently, especially during COVID. They did gradually go up, but then we've had an explosion in savings, really driven by two things. People's incomes have actually went up during COVID. A lot of that, or some of that, was government transfers, the stimulus checks and unemployment insurance and so forth. But there was an extra $1 trillion of income that people made in 2020 relative to what, again, trend would have suggested. And there was $1 trillion less money that they spent. In large part, presumably because they were locked down and couldn't really spend it. So there's $2 trillion of what we call dry powder or excess saving that is out there and out there right now in people's bank accounts. And yes, the savings rate is at, if not an historic high, certainly a very recent history high. We haven't seen savings rates like this in a long time. And so people have this money in their bank account, whether they want to get a mortgage and save money there or whether they simply want to go pay cash. There's so much money sloshing around in the system, in people's bank accounts for the most part. Obviously, they're not everybody, that's driving a lot of this housing price increase. Absolutely right.
Steve Rattner, thank you very much for that. And we're watching this happen across the country.